Okay, let's dive into this stack of sources you've shared with us. We're looking at Sharia compliance rules, specifically for trading company shares.
That's right. And it seems the focus is heavily on the AAOIFI standards, pulling directly from that material you provided.
Exactly. So our mission here is really to unpack what makes a share permissible for you, the listener, to invest in or trade, based strictly on what's in these documents.
Right. Think of it as us sorting through the details together, trying to pinpoint the absolute core requirements for Sharia-compliant share dealing as laid out here. We're using the guide you gave us.
And, for anyone trying to navigate the markets according to these specific ethical or religious guidelines, getting these rules down is pretty crucial.
Absolutely. Your sources don't just offer vague advice. They set out a pretty specific framework. There are clear rules and procedures involved.
Yeah, it looks quite structured.
It is. The material explains that these AAOIFI standards provide this whole system rules, plus ways to periodically review things designed to check if shares are compliant for investment or trading.
And this assessment isn't just one thing, it's a series of specific rules.
Exactly. It breaks down into distinct steps or checks.
Okay, so let's get into those rules. Where do the sources say we should start? What's rule number 1?
Rule 1, according to the sources, is all about the company's main line of business. They call it activity compliance, or afizi in Arabic.
Activity compliance. Makes sense.
And the core idea is simple. The company's primary activity just can't involve things Sharia prohibits, like usury, which is riba, or dealing in forbidden stuff like pork. That's an example given.
So how do you check that? Do you just look at their website?
Well, the sources say the first step is to examine the company's founding documents, the memorandum of association, things like that. See what its stated primary activity is.
Okay, the official purpose.
Yes, but crucially, the standard also stresses looking beyond that. You need to consider the actual reality of what the company does day to day. The documents are just the starting point.
Ah, okay, so check the papers, but also verify what's actually happening.
That's the idea presented. And the consequence is pretty clear. If that primary activity after examination is found to be prohibited, well, the company fails right there.
Game over at stage 1.
The sources call it the first liquidation stage, basically. Yes, it doesn't pass the initial screen.
Got it. A fundamental check. Okay, if a company passes that hurdle, what's the next rule your sources bring up?
The second rule digs into the company's finances, specifically its debts. It's called borrowing compliance, or exis.
Borrowing. Okay, what's the check here?
This one sets a quantitative limit. It says the total amount the company has borrowed based on usury on interest, basically, whether it's short-term or long-term debt, that total shouldn't exceed 30% of the company's total share market value.
30%. Now, hold on. Does that imply borrowing with interest is okay as long as it's under 30%? Because that sounds counterintuitive.
That's a really important clarification.
Yeah.
No, it doesn't mean that at all. The source material is very explicit. Borrowing based on riba, on interest, is prohibited regardless of the amount. Full stop.
Okay, glad we cleared that up. So what's the point of the 30% rule then?
It's a tolerance threshold, but not for the act itself. It's measuring the extent of the company's entanglement with interest-based debt. It's quantifying how much of the company's financial structure is, reliant on financing methods considered incompatible with Sharia.
Right. It's a measure of contamination, not permission.
Exactly. A way to gauge the level of non-compliant financial leverage.
Okay. What kind of debts specifically fall under this prohibited borrowing category according to your sources?
They list several examples. Debt from conventional banks, obviously, credit facilities, issuing conventional bonds or stocks. And also, interestingly, financial dealings between a holding company and its subsidiary that go beyond the holding company's ownership percentage if interest is involved in those dealings.
That holding company point is quite specific. And this 30% is based on market value, which can jump around a lot. How do the sources say that's handled?
Good question. The standard uses the market value of the company's total outstanding shares. Now, because prices fluctuate, the sources note that some Sharia boards use an average market value maybe over 12, 24, or even 36 months to kind of smooth out the bumps.
Makes sense.
And the standard itself, as described, generally uses the average over the last 12 months for its calculation, but it seems there's flexibility to use longer periods if market conditions are particularly volatile.
Okay, using an average helps stabilize that metric. So rule 1, activity. Rule 2, borrowing. Rule 3? Seems like the flip side of borrowing, maybe?
Get it. Rule 3 is deposits compliance. And yes, it mirrors the borrowing rule in structure.
So it's about assets this time.
Exactly. It states that the total amount the company has placed in deposits or investments that earn interest based on usury, riba again, whether short, medium, or long term, must also not exceed 30% of the total market value of the company's shares.
And I assume the same principle applies here. Earning interest is prohibited regardless, but this is a threshold for the company's overall investment structure.
Precisely. The sources reiterate that earning interest is forbidden. This 30% rule measures the extent to which the company's assets and investments are tied up in interest-bearing, non-compliant forms. It quantifies the exposure on the asset side of the balance sheet.
Okay. What examples do the sources give for prohibited deposits or investments under this rule?
They list things like deposits or accounts in conventional banks that are earning interest, investments or assets specifically earmarked for prohibited activities, holding conventional financial instruments like treasury bills or bonds if they earn interest. Also, investments in funds that themselves hold non-compliant company shares. And there it is again, those financial dealings between a holding company and subsidiary exceeding the ownership percentage, if interest is involved.
That holding company point keeps cropping up. Seems important in the standard.
It does appear significant, yes. Mentioned for both borrowing and deposits if interest is part of the deal.
And the market value calculation, same approach as with borrowing, using an average.
Yes, the sources indicate it's the same method. Based on the total market value of shares, often using that average over a period, typically the last 12 months, to manage volatility.
Right, so activity, borrowing, deposits, checked. What's next? We must be getting to the actual income soon.
We are. Rule number 4 is prohibited revenue compliance. That's shansutanyu suryu.
Prohibited revenue. Okay, this sounds like it's about the money coming in.
Exactly. This rule sets a limit on the amount of revenue the company generates from sources considered non-compliant. The threshold here is much lower. It must not exceed 5% of the company's total revenue.
5%, okay. And that applies if the revenue comes from a forbidden activity or just from owning something forbidden.
That's right. The sources say it covers both scenarios, revenue from doing something prohibited or from, say, owning an asset that generates prohibited income, like renting a property for a forbidden purpose.
What if a company's accounts aren't super clear? Some income streams can be murky.
The sources acknowledge that. They mention that if some revenues aren't clearly disclosed, an effort should be made to identify them. And if there's still uncertainty, a precautionary approach should be taken when assessing compliance. The goal is to limit that non-compliant portion of the income.
Makes sense. Can you give us the examples from the sources of what counts as total prohibited revenue? Sounds like it could be a varied list.
It is quite detailed. According to the material, it includes revenue from inherently forbidden things. The standard examples are alcohol or pork, interest earned from deposits or accounts in conventional banks, rent received if the property is used for prohibited activities, interest from conventional financial instruments or debt-based investment funds, profits made from investing in companies that are themselves non-compliant.
Okay.
Those increases from the holding company subsidiary dealings we mentioned, if interest is involved, profits from contracts that don't meet Sharia requirements, like certain forward sales or installment sales that have penalties built in.
Wow, that's quite comprehensive. Anything else?
Yes, and this one might sound a bit strange at first glance. The sources also list profits from the purification of shares of companies compliant with Sharia standards.
Wait, profits from purifying shares are counted as prohibited revenue. How does that work?
It does seem counterintuitive, doesn't it? But yes, that phrase is explicitly included in the source materials list for calculating this 5% threshold. It kind of highlights how meticulously the standard tries to account for any potentially problematic income, even income generated during the compliance process itself.
That's incredibly detailed. It shows the level of scrutiny involved.
Okay.
So let's say a company passes rules 1, 2, and 3, and its prohibited revenue is under that 5% threshold. Does that mean an investor can just pocket everything?
Not necessarily. Even if the company passes the screening, there's still the matter of that portion of revenue that is prohibited, even if it's below 5%. And that brings us to Rule 5.
Which is?
Purification of prohibited revenue, or go official sisinha somish, go up here.
Purification. Okay, so this is about the investor's responsibility.
Exactly. This rule dictates what you, as the shareholder, must do with the fraction of the company's prohibited revenue that corresponds to the shares you own.
And what is the requirement?
The sources state you must dispose of it. Get rid of that portion of the company's earnings attributed to the prohibited element. calculated per share.
Who has to do this? Anyone who held the share during the year.
No, the timing is specific. According to the sources, the obligation falls on whoever owns the shares right at the end of the financial period that could be annual or quarterly, depending on reporting.
So if I sell my shares on December 30th and the period ends December 31st, I'm off the hook for that period's purification.
Based on what the sources say, yes. The obligation is tied to ownership at the period end.
Okay. How do I figure out the exact amount I need to purify?
The calculation method described is take the company's total prohibited revenue, the figure identified under Rule 4, and divide it by the total number of shares the company has issued.
That gives a per share amount.
Right. Then you multiply that per share amount by the number of shares you personally own at the end of that period. That final figure is the amount you need to dispose of.
Dispose of? What does that mean in practice? Can I use it to, say, pay my taxes? Or maybe donate it to my favorite charity and get a tax receipt?
No, the sources are very strict here. You absolutely cannot benefit from this money in any way. It explicitly says not to use it for taxes.
Why not taxes?
The principle explained is that prohibited gain cannot become legitimate property for you. Using it to pay taxes would be a direct financial benefit, saving your own legitimate money. It can't be used for personal gain or even to fulfill personal obligations.
So no personal benefit whatsoever. Where does it have to go then?
It must be given away, specifically to the poor, the needy, or used for general welfare projects like public benefit initiatives.
And it's not considered regular charity.
Correct. The sources clarify this isn't like a voluntary charitable donation where you might expect a reward in a religious sense. It's presented as a mandatory act of purification, cleaning your wealth from a forbidden element.
Mandatory cleaning, not optional giving. Got it.
And the timing, again, locked to owning the share at the period end, like March 31st, June 30th, etc.
Yes. The sources emphasize purification is triggered by ownership at the financial period's closing date, regardless of whether you actually received a dividend payment or not. It's about owning the claim on the company's assets and earnings at that specific point.
Okay, that covers the 5 main rules for assessing the company and handling its income. But you mentioned the sources also cover something else. Prohibited investment methods.
That's right, EZS-NUA. This adds another crucial layer.
So even if the company's shares pass all those tests we just discussed, the way you trade them still matters.
Precisely. The sources outline that certain methods of trading or investing in shares are themselves prohibited under Sharia, even if the underlying share is deemed compliant.
Okay, what kind of methods are we talking about? What examples did the sources give? The list includes things like trading using contracts that are incompatible with Sharia principles. They specifically mention certain financial derivatives like futures, options, and swaps, especially those based on indices.
Right. Derivatives often involve speculation or uncertainty. That's problematic. What else?
Short selling is listed as prohibited. Buying shares on margin, meaning using a loan that involves interest to buy the shares.
Margin trading, yeah, that makes sense given the rules on interest.
Also, renting out your shares to someone else for a fee, pledging shares as collateral or security for a loan, trading shares using salam contracts. These are specific forward contracts with strict Sharia conditions that might not apply easily to shares. And finally, dealing in preferred shares or enjoyment shares.
Preferred shares often have features that resemble debt or guarantee returns, which can be an issue. So it's a whole extra set of rules just for the act of trading.
It really emphasizes that compliance isn't just about picking the right stock, it's also about how you interact with the market.
Definitely adds complexity. Now, the final piece mentioned in your sources seems critical. Periodical review.
Yes, son se say. This addresses the fact that markets and companies aren't static.
Things change.
Constantly. So the standards, as described, emphasize that you need to continuously monitor the company's compliance with all these rules throughout the entire time you're invested or trading. It's not a one-and-done check.
Continuous monitoring. How intensive is that? What does it involve according to the sources?
It involves keeping track regularly. The sources even mention daily monitoring of stock prices. And also keeping an eye on significant company events.
Like what kind of events?
Things like mergers, acquisitions, major restructurings, dividend announcements, stock splits, anything that could materially affect the company's financials or structure.
And why track all that so closely?
To see how these changes impact the company's Sharia compliance status. A merger could change the activity mix or alter debt levels. Market value changes affect those 30% thresholds for borrowing and deposits. New financial results affect the prohibited revenue calculation and the purification amount per share.
So it's about keeping the assessment up to date constantly. Where does the data for this ongoing review come from?
The sources say the primary source should be the company's latest audited financial statements, along with any clarifications they provide. That's the gold standard.
But audited statements only come out periodically. What about between reports?
Good point. If audited statements aren't available for the very latest picture, the material suggests using other reliable non-financial data sources for estimations. This could include things like sector research reports or consensus estimates from industry analysts.
So you use the best available data, starting with audited financials, but supplementing with other credible info if needed to keep the review current.
That seems to be the practical approach outlined, yes. A mix of official data and informed estimates when necessary.
Okay, so let's try to pull this all together from our deep dive into your sources. We've covered quite a bit.
We have. It's a multi-layered process.
Yeah, first checking the company's basic activity, is it permissible? Then looking at its financial structure, those 30% thresholds for interest-based borrowing and deposits relative to market value.
Right. Then scrutinizing the income, that 5% limit on prohibited revenue.
Followed by the investor's duty, the requirement to purify your share of any prohibited revenue identified.
And on top of all that, the rules about how you invest, avoiding prohibited trading methods like margin trading or short selling.
And finally, the need for constant vigilance, that periodical, even daily review using the latest available data.
It really paints a picture of a very thorough, ongoing assessment process described in these AAOIFI standards from your sources.
Absolutely. This deep dive based on the material you provided gives, I think, a pretty detailed roadmap for understanding what Sharia-compliant shared dealing entails according to these specific standards.
It definitely lays out a clear, if demanding, path, which brings up a final thought maybe for you to consider.
Go on.
Given how fast financial markets move and how companies are always restructuring, merging, changing, how does that requirement for continuous, maybe even daily review practically impact an investment strategy? If you're trying to adhere strictly to these detailed standards, that constant monitoring adds a significant operational layer, doesn't it? Something beyond just the initial stock pick.